Lecture 12 covers debt finance. We talk about short, medium, and international debt. Okay. So this is a lot of theory lah, and understanding new things. So here we only talk about short term, medium term, and international kinds of debt financing. So debt financing is opposed to equity financing. So when we um, have a business, financing can come from several ways. So one of them is equity. Always people who are new and starting up a new company, the first way of financing is usually through equity, because debt although is available everywhere, but it is usually very hard for new companies to take debt. All right, especially long term debt. So like smaller or newer companies, you'll be talking about short term and medium term debt, and usually they are not able to take such a big amount of debt, right? Because debt usually requires a good rating. Like all of you, when you are still studying and you are probably much younger, you want to take that facility is hard, especially when you want to apply for a credit card for the first time. It's hard. You want to apply for a housing loan or a car loan, it's also a bit hard because you currently do not have a credit rating. Okay, once you have all these, then the subsequent credit card, futures credit card, taking on loan will be easier once you have a good credit rating. All right. So another way of informal kind of debt financing, all right, where in your accounting records recorded under liabilities is the trade credit. So trade credit is an informal way of debt financing because you take goods but you do not pay for it. Usually, this is allowed where companies buy raw materials and they have a 30-day payment period, so they can pay anytime during the 30 days. Right? See, so this is a credit or debt facility given by the seller or the supplier. So what you can do within the 30 days, these 30 days you can do all you need to try to sell the item. After selling, then you can pay back to the supplier. So this kind of credit financing is usually convenient and cheap and available to all sizes of company, small and big. Big companies like Tesco, they do that. So like if you want to sell or deal with Tesco or big supermarkets, they want to sell for you. In order to sell for you, they will require trade credit. That means once they take your item, they will take a few days, probably 30 days or 1 or 2 months before paying you for the item. So during that period, they are taking your goods for free. So that way, Tesco do not have to pay for everything that they put in their shop. Right? Then they do not need so much money or so much equity or debt financing. They just need to provide the shop and they sell your item. And after selling, then only they pay you back. Okay, so factors determining the terms of trade credit are usually based on the tradition in the industry, bargaining strength of two parties, and also the product type. Another meaning of product type is, for example, those mini market, uh, they sell bread, gardenia bread, and so on. So usually shops like this, it's a bit hard for them to sell bread, right? Because bread is perishable. That means bread cannot last long, maybe 3 days, 4 days only. So they will not want to take much stock. They probably, if you want them to sell, you charge them cash. They probably only take one or two or three, because if they cannot sell, then the bread will spoil. So what happens is, usually bread, things like this are so are put there to sell. So they do not pay for the bread until it is sold. So the payment is based on how many bread they were sold. Then the remaining one is taken back, right? So this is what also some sort of trade credit financing, and also what we call as consignment. Means you take the stock for free. What you sell, you pay me. What you do not sell, you return back to me. All right. So usually an invoice will show like this lah. Okay. How do you know there's trade credit? When you look at the invoice, right? There is a due date, and there is a settlement terms. Okay. Usually you see this, it is considered that this product or this supplier is giving trade credit. See, that means you can pay 30 days. Within 30 days, the next 30 days you can pay. Otherwise, if you pay earlier, within 14 days, you get discount. Okay, so this is the example how to calculate. Okay, the next method is called factoring. All right, factoring there is split into two types. Okay, one is called recourse. Okay, if you forget, you forget, you can write it down, and later on you can Google the meaning. But I will explain once also lah. Right, non-recourse. So recourse, factoring is also a credit facility. Okay, how factoring works? When you are a supplier, okay, you supply goods to your customer and you give them credit terms, let's say 30 days. Why do you give them? Because probably your market is the item that you sell is very competitive. Competitive in the sense that many people selling the same thing, many people supplying the same thing. So in order to make your customer buy from you, you don't only provide a normal discount, but you provide credit facility. That means you do not require your customer to pay immediately. You give them 30 days. So during the 30 days, customer can decide when to pay, as long as do not exceed 30 days lah. Alright. So when customer take your goods, you send them an invoice, the right to receive payment. Okay? So what you do is, suppliers, right? When they give a lot of people trade financing, trade credit, supplier themselves will face credit problem, because all item they sell, they don't collect money first. 30 days only they collect. So how do they have enough money to continue their operation? until the 30 days is up, then only they dare to collect. So how do they survive without money for 30 days? So what they can do is they can look for a factoring company, because they know that within the next 30 days, this customer will pay to the invoice. But they need the money now. They cannot wait for even 20 or 10 days. They cannot wait. But they know this customer is going to pay. So what do they do is they take the invoice and sell it to a factoring company. So what the factoring company will do, the factoring company will buy your invoice. All right, let's say you sold a customer $1 million of goods. So you sell to the factor 80% of your customer debt. So you will get how much? If you sold $1 million goods, you will get 800,000 immediately cash from the factor. All right, based on your invoice. So what will happen is within the 30 days, finally when customer pay your debt, okay, when customer pay your debt, then the supplier who took the 80% in advance now can claim for the remaining 20% minus all the fees. All right, but they have to pay back the factor lah, of course. All right, so this is how factor works. And factor, right, there are recourse and non-recourse. So what's the difference? Okay, recourse means you only, as a supplier, as a seller, you sell the invoice to the factor, but the factor do not collect your debt. They only give you money in advance. You still need to collect the debt from the customer. So if customer don't pay, no choice. You consider bad debt because customer don't pay you. Okay, but in a non-recourse factoring, that means you sell the whole debt to your factor. So the factor will have to be responsible to collect the debt. So if the customer do not pay, you as a seller, you do not suffer. The factor will suffer. So under non-recourse, that means when you sell the invoice to your factor, they already take over the risk. So if this customer don't pay, then factor will have the bad debt. Okay, so this is the difference between non-recourse and recourse. I'll repeat, non-recourse means when you sell the invoice to customer, to factor, the factor will collect. If the factor cannot collect, then no choice. But you will still get the payment. So non-recourse is like with insurance lah. Right? But all in all, factor is still a finance providing company. So usually they will charge interest for all the money that involved. Okay, so factoring, these are the details, the provision of finance and what are their uh, services they provide. All right, services they provide. They provide sales ledger admin, credit insurance, invoice discounting, and so on. So alternative way to debt financing is hire purchase. So instead of taking debt, borrowing, no need. You take on this hire purchase facility. That means when you, instead of coming up with a big amount of money to buy a machine or plant or equipment, you don't have to pay out everything first. Why? This is very important. Okay, for example, companies like AirAsia, they buy what? What is their machinery? AirAsia machine is aeroplane, Airbus. So in order for AirAsia to operate, they cannot have just one plane. One plane fly where? KL to Sabah. No. Uh, Company like AirAsia, they need to have many planes, even hundreds of planes. Why? They have to provide service not only to Sabah but to many countries as well. So AirAsia, in at the start of the operation, they need to have maybe 100 planes. So how can AirAsia afford 100 planes? Airbus, how can they afford? So usually they don't buy all these planes with cash. Let's say one plane is 1 million. Of course, it's more than that. But for example, one plane costs $1 million. So to start a business, they need to have 100 planes. So they need $100 million. So where do they get so much money? They cannot. So what usually this company they do, they go on a hire purchase agreement. That means they only need to pay a down payment, let's say 10% of the whole item. So in Airbus, they buy 100 million, they only need to pay 10% first. They only need to pay 10 million. 10 million is so much smaller amount. And then what else? What about the remaining 90 million? The 90 million, they take loan. They call a hire purchase loan. So what do they do is once they take this hire purchase facility, they the remaining 90 million can be paid back to the bank slowly. Okay, so the plane will belong to the bank or the credit provider who provide the hire purchase agreement facility. It will belong to them until you finish paying. All right, so you look at this flow of diagram in this slide. When you want to buy the plane, you you get a hire purchase company. So what the hire purchase company, they will buy the item for you. Okay, because for you 100 million is a lot, but for the bank is very small. So the bank will pay for you. What you need is probably just pay the small deposit of 10 million usually. So you will get the plant or equipment for immediate use. So you are called the hirer or the purchaser lah. You are the buyer, so you are called the hirer. But you don't buy it because you just pay only 10%. So you are considered the hirer. However, as you hire, as you are the AirAsia, you use it, you make regular payment. It's just like rental. Then every month you make payment. Then after a certain period of time when all the payment have been made, then you, the AirAsia, will become the owner of the planes. Only after you finish paying. Alright, this is the hire purchase agreement. So what are the advantages and how does it help a lot of company? It's because you only need a small initial outlay to buy something. And it is easy and quick to arrange. Why? Because the ownership of the item is not you. It belongs to the hire purchase. So they are not so scared. They feel more secure that you won't run away. Even if you run away, what happens if you do not pay for your hire purchase item and you run away? They are not worried because the item is not yours. So you just make a police report and the police will catch you for them. Right? Certainty is available all the time, and you can opt for fixed rate financing and hire purchase. can actually provide tax relief. So all this monthly payment, every month that you pay, it is actually considered as expense, right? Because you are buying something for the use of uh, your operation. So it's called as expense. So you can reduce your profit and you can make tax savings. So next is leasing transaction. Difference between leasing and hire purchase is that when hire purchase, you hire with the intention to purchase. That means every month you make payment, but at the end, the ownership will transfer to you. The other method of financing is leasing. So instead of buying, usually when you are a photostat shop, you don't buy the machine. Why? Because it is probably expensive to maintain, very hard to maintain. And photostat machine, they have a new model coming every few years. The model will keep changing. So how? Usually photostat shop, right? They will go on a leasing agreement. That means they will lease or they will rent a machine, the photostat machine. They will rent it for use, and and the ownership will never transfer to them. That means they have no intention to buy. They only provide the service. How? They rent and they provide the service and they make weekly or monthly rental payment. What's the benefit? The benefit is that they will never own the machine. So the rental usually is cheaper because they don't own the machine. But best thing is when they make rental payment, the ownership do not change. The owner will always be the rental company. So because they will know that this item will not be sold to you, they will perform regular maintenance. They want to make sure that the machine is well maintained so that in the end they can sell it or they can continue leasing it to people. So because the item is not yours, you just use it only. You don't worry about the maintenance or you don't worry about the repair. As long as the you do not misuse it, the the regular maintenance will be performed by the owner of the machine, not you. You are just the lessee. That means you rent it for using only. All right. So another leasing transaction is let's say you you travel to Singapore for work. Let's say you need to work in Singapore for 1 year. So this 1 year you need a car. But the problem is when you buy a car for 1 year, it's very troublesome. That means after buying and everything, after you use for 1 year, you need to prepare to sell the car. Right? Very troublesome. And you don't know what will happen during the 1 year, whether your car will face a lot of maintenance issue or not. So you don't buy your car. What you can do is you can lease for 1 year. So you go to a leasing company, you rent the car for 1 year. That means the car will not belong to you. You are only using it. So you pay the rent and you use the car. After 1 year, you just return the car. The car is not yours anyway. Alright, so this is how leasing works. That's the main thing to remember is that leasing means you use an item that will not belong to you. Right? You are just using the facility. So there are two types of leasing. One is operating and another is financing. So operating lease is usually borrowing or renting something such as equipment or machinery. But financing lease means renting money. You rent finance. You borrow money. So the advantage is you start a business with small initial outlay, certainty, availability, and fixed rate financing. Tax relief is also available because leasing is an expense, right? So you can reduce your profit and reduce your tax. So this is a example of balance sheet for company Y. You see, if you look at company Y, is when they use operating lease. They they lease an equipment of 1 million and they use it for 1 year. Okay, they only pay rental. They only pay rental, but it doesn't show in the balance sheet. However, company X is different. They have $1 million debt. Why? Because they borrow 1 million in order to buy equipment. Okay, so this is the difference. Y lease the equipment and X buy the equipment. So the difference is that company X shows that they have so much more debt. So just by looking at this company X and Y, you will say that company X is more risky. So you don't want that. All right. So the next is international sources of debt finance. So as your company gets bigger, business gets bigger, probably you do not only look at the domestic debt market. What you can do is you can look for international sources of debt. There are many reasons why you look for international sources, right? You don't just rely on Malaysia because one is there are probably certain things that you benefit. For example, if you want to buy certain phones like LG phones, LG phones are quite good, but LG phones are popular in Korea. So there's this model in LG phone that there is two edition. One is international edition, one is Korean edition. All right, very easy is the difference is if you look at this phone, if you buy the Korean edition, you have 4 cameras. You buy the international edition, there is 3 cameras. So which phone can you buy? You can buy either one. But only one available in Malaysia market is the international model. Only 3 cameras. So how do you get a phone with 4 cameras? You have to go international market. You cannot stay in Malaysia to buy. So same as debt financing, there are certain types of debt facility you cannot get locally. You can only get in the international market. So this international source of debt is called the euro market, and they call it as euro currency. Doesn't mean that they use euro. All right, it can mean any other currency, but they just call it as the euro market for international sources. So, who can look at international sources? Usually, companies that are large enough, right? That are not small, they are large, so that they can look into international market, and from there they can probably get an advantage over smaller firms. Why? Okay, if you are a big company versus a small company, big company have the additional benefit of going into international market for funds for debt financing. So the benefit that international market players is that they can source for cheaper funds. Right? They can source for cheaper funds. So this is one competitive advantage that they can get over smaller companies who have no access to the international market. All right. And not only that, so bigger companies usually they deal with international buyers also. So in order to uh, hedge foreign currency, that means when like let's say AirAsia, they operate a lot in a lot of countries. They don't just operate in Malaysia. So let's say they operate in Japan, they operate in Thailand. So if their big market is in China or Japan or Thailand, so their that in ringgit is not really that useful. Why? Because if ringgit becomes weaker in terms of foreign exchange, that means the salary they have to pay for their overseas staff is higher. So what they can do is they can take a debt from the international market denominated in US dollar. So when they borrow in US dollar, they can pay their staff in US dollar. So they will not be affected by foreign exchange movement. Alright, so all the transaction, all the payout, they use US dollar. Salary or pay US dollar. So when you do that, then they will not be affected. Their costs will not be affected when ringgit becomes less powerful. Okay. So in the bond market, bond is also a sort of debt. So in the bond market, uh, you can be split into three: domestic, foreign, and euro bonds. So what is euro bonds? Euro bonds is usually a very big uh, denominated bond. Usually when you borrow a lot, then you go into a euro bond market. So euro bond is an international bond, and if you look at the first point here, euro bond here are actually bonds that are sold outside the jurisdiction of the country of the currency in which the bond is denominated. Okay, let's say, for example, Malaysia um, borrow from Japan. Okay, when Malaysia borrow from Japan, because Japan interest rate is low, so Japan also willing to lend money to us, All right, so when Malaysia borrow from Japan, but Japan produce what currency? Japan use what currency? So they lend what currency? Yen, right? Japanese yen. But Malaysia, they don't need yen. For what we borrow yen? Malaysia don't need yen. What Malaysia would probably want would be US dollar. Okay? So what they do is Malaysia want US dollar. But Japanese got money they want to lend. So what Japan and Malaysia agree on? Japan and Malaysia agree on that instead of using yen, they use US dollar lah. But still Malaysia will borrow from Japan, but in US dollar. So this one is like is a sort of euro bond. Why? Because rightfully Malaysia borrow from Japan should be in yen. But how come it become euro bond? Because Malaysia borrow from Japan not in yen but in US dollar. So if you refer to the first statement here, euro bonds are bonds sold outside the country. This Malaysia sell the bond to Japan. Japan will buy our bond, but not using ringgit, not using yen, using a third currency, using US dollar. So this is a sort of euro bond, but in Malaysia we don't call it euro bonds. We call it samurai bonds. They rename it samurai bond. Euro bonds is usually they call euro because it's famous. People buy them using euro. But now Japanese people buy it using dollar. not yen, using dollar. So they call it a samurai bond. Okay, you can Google them. Very popular. The word samurai bond, samurai. Okay, not too long ago, uh, Tun Dr. Mahathir announced the Eurobond, this purchase of the sale of samurai debt. Right? So you can go on to see the rest. So what is an advantage of a Eurobond? Because Eurobond is issued in a large denomination. Usually, Eurobonds have ability to take on larger and longer period loan. That's why Malaysia, as a country, we borrow samurai bonds. We borrow using samurai bond, and it's often cheaper. You can hedge interest rate and exchange rate. Why? Because they are using US dollar. Usually unsecured, that means you do not secure it with any asset. It is based on credit rating and a lower level of regulation. You can have a lot of clauses which you do not need to go through uh, the normal country regulation. Okay. However, the drawbacks are usually for larger companies. Only big companies or countries can buy or sell Eurobonds, and the risk is basically related to exchange rate fluctuation. That means because ringgit, our country is earning in ringgit, Japanese is yen, but we are borrowing in US dollar. So there might be an exchange rate risk. However, secondary market can be illiquid. That means when we borrow from Japan, so only Japan can lend to us. What if Japan needs money? When they sell it to someone else, maybe nobody can buy because the amount is too huge. So no secondary market. All right. So now, going into medium term. Shall we have a short break? We have a 10 minutes break and we continue after. Okay, we come back at about before 9:30. Okay, are you all still here? Okay. So we continue before 9:30. Okay, about 9:30 lah, 9:30 lah. Okay, see you back in 9:30. 10 minutes break. All right, welcome back. Everyone back? Okay, I hope all of you are back. Huh? Okay, if you are back, let us continue with our lecture. Okay, let's continue. So, in terms of financing, there will be long term, medium, and short term. So, it all depends on the demand and also supply. So, there are some people who some business require medium term financing, some require long term. So, when we were talking about euro bonds and big financing, those are long term. All right, they usually big amount and usually takes a very long time to pay back. And trade credit and also factoring, those are short term. That means you use it within a few 1 month and so on, and then you pay back. And then there's the leasing and also hire purchase, which is also could be long term kind of financing. Now we talk about the medium term financing. So medium term financing can be in the form of borrowing. So you borrow, but maybe not long term, not 10 years, maybe 5 years. So you only need money for 5 years, then you go for medium term financing. So medium term financing, you can go for this MTN, medium term notes, usually unsecured and may carry float or fixed interest rate charge. So if you are worried about the interest rate fluctuation, then you go for fixed interest rate financing. It can be as little as 9 months or as long as 30 years. Okay, but they still call it medium term loans. All right. So another one is called the commercial paper. Usually, commercial paper is a kind of a short term financing. So you have money, but you have no place to put your money. Okay, so you can put it in by buying commercial paper. So you buy this, that means you are lending money to people for about 1 month or up to 270 days, usually less than 1 year. Okay, commercial paper. So you can sell it if you need money. You buy it if you have extra money. So some companies they have extra cash in their pocket and they have no place. Maybe the bank gives too low interest rate. So what they can do is you can buy a commercial paper. All right. So this is also a type of financing. And so when we talk about debt financing, the main thing that we will come to is the uh, yield curve. So what is yield curve? Yield curve is basically the interest rate that will affect debt financing. So if you see yield curve can be this shape in this slide. You can see the shape of a yield curve. Okay, so yield curve means what? If you look at, let's say you look at the first one, United Kingdom, UK yield curve. Okay, so what is a yield curve? That means if, let's say, you borrow or you lend for 2 years, okay, you borrow or lend for 2 years, then the interest rate will be 0.5%. Okay, 0.5% per year. But if you borrow for 5 years, the interest rate is about 1.5%. Right? And if you borrow even longer, 10 years, interest rate will be 2.5%. And if you borrow, let's say up to 20 to 30 years, your interest rate will be close to 4%. Right? So this is the yield curve. So what determines the yield curve? How come it is upward sloping? Okay, you can see it is upward sloping as the number of years increase. So the higher the number of years, the higher the yield, therefore causing the yield curve to be upward sloping. But why? Okay, so the hypothesis is that there is three possibility: expectation, market segmentation, and liquidity preference. Okay, market segmentation. Let me start with market segmentation. But market segmentation means there is a different supply and demand for each level of yield. So, for example, market segmentation for 2 years in UK, 2 years. Why is the yield curve showing so low at 0.5%? It's probably due to market segmentation that there are a lot of supply, very few demand. That is why the yield is low. But if you look at 30 years, right, market segmentation will explain that because the supply of 30-year financing is low, but the demand is high. Because the demand is higher than supply, therefore, the cost or the price increase. So yield is like a price of borrowing. So the longer you borrow, the higher the interest rate due to supply demand. Higher demand but lower supply. Okay, that is market segmentation. Liquidity preference. What about liquidity preference? Liquidity preference means people usually prefer to have liquidity. So they do not want to lend money for 30 years. So in order to attract people to lend for 30 years, you have to give them a liquidity premium. You have to give them a higher price. So in order to attract people to lend, then you give a higher price so that people lend. So liquidity preference theory. The next one is expectation theory. So people tend to expect that in the long term, so 1 month to 2 years, maybe people expect that the interest rate will not change much. So they are okay to settle with 0.5%. But longer than that, people will expect that interest rate will be different. Okay? People know that the interest rate will not last forever. Anything that happen to the market or anything, it will affect the interest rate. So therefore, the longer it is, when you lock in, people will expect the interest rate to increase. Okay, due to this expectation theory, the longer the borrowing terms, the lending terms, then the yield will also be higher. This is based on the expectation theory. So you can look the comparison between different countries, UK, US, Japan, and Eurozone. So you can now see that comparing all these countries, which interest rate is the lowest? You can see Japan. And that is why Malaysia issue samurai bonds. Let's say Malaysia need, due to the previously, they have a scandal, and Malaysia is also a developing country. They need money to fuel the economy. They need money to continuously fund the budget to increase the infrastructure of the country. So they need money. Money can come from tax lah. When you pay tax, then the country get money. But because of the last 2 year, they removed the GST, goods and services tax. They removed that, so the country have less income. So how do they cope with less income? They need to borrow. Right? So they borrow from the right country, which is Japan, because the interest rate is much lower. Let's see, you borrow from Japan for 30 years, how much interest you pay? 2%. Right? You borrow from UK for 30 years, you pay 4%. US for 30 years, 4%. Eurozone is about 3%. So the cheapest is still Japan. All right, Japan. And Japan's low interest rate can also be explained using the yield curve, one of the theory. Okay, so Japan, why is the interest rate so low? One is, I can explain using probably I use a market segmentation theory. Okay, I use a market segmentation theory. What makes Japan interest rate yield so low? Okay, Japan is an Asian country, and Japanese people, they live long. So when they live long, they know that they will live until maybe 100 years old. So when they are young, 20, 30 years old, they are working, even 40, 50 years old, they know they can live another 50 years, even when they are 50 years old. So what they do, they save a lot. They save a lot. So when they save a lot, they don't expect to live only 20 years or 30 years. They expect to live more than that. So when they save a lot, the supply of money for 30 years financing is high. So because of high supply, so the demand is not that much also. So therefore, the interest rate is low due to high supply. Okay, and Japanese people work very hard. So they make a lot of savings and they save. And not only that, they consume less, because Japan is a aging country. That means a lot of old people, more old people than young people. So these older people, they consume less, they eat less, they, even the phones, the cars last very long lasting, so they don't spend much. And this is also one of the reason why they save a lot, and this saving of high saving contribute to their low interest rate. Okay, so these are the explanation of others in details. uh, in conclusion, this chapter would ask whether short term or long term borrowing, what to consider. So to decide whether to borrow short term or long term, things to consider would be the maturity structure, the cost of arrangement, flexibility, uncertainty of getting future finance. That means if you are not certain that you will get future finance, then you will consider longer term financing. Right? And also the term structure of interest rate. Right. So a lot based on this graph, see you can identify how much debt is due within 1 year and more than 5 years. You see that within 1 year, short-term financing a lot of demand. Long-term financing more than 5 years also very high amount. Medium term is more or less not too much. Okay, so this is yield curve. And yeah, that's all for this chapter. So this entire chapter talks about all these things which are from short-term financing to long-term financing. This will be related to your course of strategic financial management, because you will need to know how to manage your finance effectively, right, in the future. Okay, so that's the end of this chapter. It's the end of this chapter, lecture 12. So for tutorial later, we will look at this. Let me share. Okay, so for our tutorial later, we look at lecture 11, last slide, tutorial 6, chapter 8 of your textbook on long-term debt finance, page 472, question 1, 2, 3, 4, and 8. So we will learn the basics on how to determine and how to calculate debt and the cost of debt. Okay, so this will be the summary of today. Any question so far? Everyone okay? Okay. We okay. I hope all of you are doing okay.